Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts, and important levels on the ForexPeaceArmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit ForexPeaceArmy.com forum and read my analysis for the week before watching this daily video.
Greetings everybody. So on the gold market currently, it's very interesting situation, even more interesting than the forex market. It's because it's deep in the wood. We're going, it's more interesting and tricky it becomes. So in two words speaking, actually yesterday we have tried to find the tricky moments in the fundamental environment when we discussed the situation on the forex, taking on some indirect indicators that shows that we probably should meet the recession in the United States earlier than everybody suggests. So by our opinion, ForexPeaceArmy suggests that the first signs of the recession could come as early as by the end of 2022. Today in the gold report, we're trying to dig it a bit deeper and take a bit more specific view in terms of the gold market, how it could make impact on it. And mostly we were watching for rate change cycles from the Fed and explain why currently United States economy is not ready for another tightening cycle. It's just because in the previous cycle, this was in 2016-2018, market was not able to accumulate necessary power, not the market, the economy of course. Economy was not able to accumulate the necessary power to absorb the new tightening conditions that Fed currently provides. So in the previous cycles, economy was boosted by the interest rate drops that was greater than the previous rate hike. And that previously led households, companies to refinance the existing debt, loans, mortgages, and to extract additional cash for triggering and increasing consumption. It every time happens when Fed, for instance, rising rate in the previous cycle for 4%, but it dropped it on the downside cycle for 5.5%. That tendency was standing since 1995. If we exclude from the consideration the inflation spiral of the 1980s, this tendency was holding even longer. But in the recent cycle, Fed was not able to raise rate for the 3% and was not able to cut it more than 3% just because it hits the 0 point. And in the last cycle, the economy was not able to absorb even 2.5% rate change. So once Fed has raised rate for a 2.5%, economy shows clear signs of the recession, and Fed had to reverse this tendency very fast. And currently, we're coming in this situation when the recent downside cycle was too small to provide necessary consumption power to the economy, and Fed already is raising rates again. Our suggestion on the ForexPeaceArmy that the targets that Fed set for this cycle, as they intend to reach the 2.8% of the terminal rate by somewhere in 2024, is just impossible target. So they will not reach this level, as the economy shows the recession much earlier, and the Fed will not have the chances to reach it. Currently, it's a bit tricky situation. Why? Because Fed appeals to great performance. So we see the very low unemployment, we see some more or less good consumption, retail sales, gross domestic product action, and they tell, well, this is a very strong economy that probably it is ready for a new cycle. But taking into consideration that statistics doesn't show yet the commodity explosion. that we've got starting in March, and currently we're getting numbers only for February. By our view, more or less real statistics we will get in May and June. And that will be, I suppose this might be the cold shower for everybody. So this is the first moment. Second moment, indirect signs such as the mortgage levels and demand for houses already shows downward action. Currently, just when the one uptick from the Fed, the level of the mortgages, to serve the mortgages, it takes approximately 20% of the household budget, its monthly budget. It's already a valuable amount. So, taking other specific reasons aside, so you could read in the report, that's because other reasons also exist, and taking the really tough geopolitical situation, so that definitely provides a healthy support to all commodity prices, and gold is not an exception. Our suggestion that in the longer term, the gold is a great asset for investing and for saving the wealth. And we do not consider any strong and starting of the bearish tendency, bearish trend on the gold market right now. So we think that gold should stay around the top, and maybe it's at some moment could start upward action. So mostly just because we suggest that real interest rates should remain negative, and that is major driving factor for the gold market. That's what about fundamental background currently. It's a lot of nuances there, so if you're interested with that, you could read report. So speaking on the technical side, since we have big weekly bearish pattern, it suggests it has some momentum, and it suggests some extension to the downside, which we treat as a retracement. We don't think that will be starting of the bearish tendency. But we have to accept it, and we'll keep going with our ABCD pattern, and with the C point that should clarify where this extension of this pattern could start. Last week we suggested that 1960 it might be proper point where it could start the extension of the downside action. But with the new information that we've got last week and the price performance around 1960 level, we suggest that it is more probable that downside reaction might start from the 2000 level. And from that standpoint, here you can see the MACD predictor stands very close to this area. And that is usually where taking a look at it, keep watching for a bearish grabber around the 1000 area. Once market completes intraday target, if we will get bearish grabber on the daily chart, all the better. Here will be opportunity for traders to take the short position with a possible extension to the downside, this ABCD pattern. So that's in short what we're watching for on gold market right now. On the hourly chart, in the beginning of the week, market could show the proper reaction on this resistance, because this is relatively strong resistance, guys. We already mentioned it previously. Market has completed ABCD pattern here. We have confluence, we have natural resistance, as you can see, support resistance line. So previously was resistance, breakout, support, support again. Now it's again will be resistance. And market already reached the 30%, but we treat the most probable level for retracement as confluence 1932, 1939, and 1944. So approximately this scenario around 1935, 1938 area. So maybe this will be kind of the ABCD pattern or something of that sort. So this level is most probable this market should hold before upward continuation. That's why if you're a scalp trader, you could keep watching for this area for taking the long position. Watch for patterns, watch for extensions to this moment, to this point, to choose the proper moment for taking the position. For bearish position taking, this reaction stands very gradual and slow. It doesn't look like starting of the continuation of this action that we're waiting actually. And this makes us think that for taking the short position, it would be better to wait reaching at least 2000 area. This will be 618 resistance. This will be XOP, the same ABCD pattern that we have. agreement, and maybe, as I said, it might be the grubber on the daily chart. So that combination might provide necessary background, the context for taking the short position as well. These two moments that we intend to keep an eye on next week in the gold market.